Hey guys, it's Akeem here. Welcome back to another video. And of course, today we're going to be talking about Netflix, especially considering the fact that they just released their Q4 2021 results and the markets did not like it at all. And the stock fell by almost 25% as a result of that. And also when you zoom out a lot further, you can see that it has highs or all-time highs of $692, which means that at the current price, it is down over 42%. So naturally, this gets people asking the question, does this now mean that this is a buying opportunity? Has the market overreacted? And could this mean that we get a good return on our investment if we invest at today's prices? We're going to cover all of that today, as well as the Q4 results. So let's get into it. But just before we dive into the latest results, it's always a good idea to take a look at the headline news to get an idea for why the market has reacted in the way that it has. And we can see here an article from the Financial Times, which reads, Netflix warning on subscriber growth sends the stock plummeting. And when we actually get into the detail, we can see that Netflix have said that they would add 2.5 million subscribers in the first 3 months of 2022. And that is far fewer than the 4 million that it added in 2021 in the same quarter. And it's also well below analysts' expectations that also stood at 4 million. So in effect, Netflix is saying that their growth in subscriber additions are slowing dramatically. And that doesn't sort of compare with what analysts were expecting, which was that we was expecting at least that growth to be flat, or at least flat in absolute terms anyway. Now, Netflix is one of those companies that really needs no introduction. I'm sure the vast majority of people that are watching this video either have a Netflix subscription or have had a Netflix subscription. And if they don't, then they're probably using their friend's subscription, right? With that being said, just because we enjoy the services and the products of a particular company doesn't necessarily mean that it's a good investment. We have to dig into the financials and the fundamentals to understand whether there is a reasonable chance or reasonable probability that you're going to see a solid outperformance of the market on that investment. Now, despite the fact that competition is undoubtedly hotting up in this space, especially through the likes of Disney Plus and the soon-to-be merged company of Warner Brothers Discovery, there's also no doubt that Netflix continue to be the market leader, particularly when it comes to TV shows. So we can see here that out of the top 10 TV shows, Netflix produced 6 of those. But that hasn't stopped management from mentioning that increased competition, which we see down here. So management have said that while this added competition may be affecting our marginal growth, we continue to grow in every country and region. So it's clear that actually this increased competition is having an impact on the number of subscribers that Netflix are able to acquire. And that makes sense, right? Because with this particular service, you're only going to want 1 or 2 subscriptions. And as a result of that, increased competition means that there's a less likelihood for you to choose, for example, Netflix's service. Anyway, so when we get into the details of the financials, we can see that revenue in Q4 2021 grew 16% year over year with a 9% increase in average paid memberships. Now, when you actually think about it, right, Netflix is a business that is trading at pretty high multiples, and considering the fact that they are only growing 16% year over year, that was obviously a cause for concern for many investors, and I'm not all that surprised. When you're paying high multiples for a business, you expect that business to continue growing at a high rate. The moment that those high rates of growth go away, then of course we see margin or multiple contraction. But it's not just the slowdown in revenue growth that is concerning, it's also the margin contraction that we're seeing as well. So we can see here that revenues grew from 31st December 2020 at $6.6 billion to $7.7 billion a year later. The problem is though, is that their operating income went from $954 million down to $632 million. It's gone the wrong way, which of course is not a good sign at all. And when we dig into the reasons for that decline, we can actually see that their gross margins have decreased quite significantly. And not only that, they're actually spending more on general and administrative costs, as well as technology and development. Now, an increased spend on technology and development isn't necessarily a bad thing, because in theory, that should mean that they're producing better content, which will later down the line effectively pay dividends. But when you're seeing increased costs in their general administrative costs, as a percentage of revenue that is increasing, well, that's not very good, because it suggests that they are not increasing their operational efficiencies. They're actually decreasing their operational efficiencies. And as an investor, that is something that I do not want to see. With that being said, they have actually managed to increase their profit before taxes from $506 million to $550 million. And we can see that that is a result of a $350 million swing in their interest and other income or expenses. So it's important that we dig into that to see whether that is a long-term trend or if that's a one-off expense or income. Now, in terms of the balance sheet, well, actually the business is doing okay. And to be honest, that is expected. So we can see here that cash and cash equivalents is sitting at $6 billion for the quarter or the end of the quarter. and that was actually $8.2 billion the year prior. So if you just only looked at that, you might be wondering, well, where has their cash gone? Well, actually, they've put it to good use. So when we go down to long-term debt, they did have $15.8 billion of long-term debt, and they've actually managed to pay down that quite significantly to $14.7 billion. So they've paid down their long-term debt by $1.1 billion, which isn't too bad at all. Management have also said that they expect to be free cash flow positive from 2022 onwards, and as a result of that, they're going to be using much of that cash to be paying down that debt even further. Now that brings me on to point 2, which is free cash flow. So Netflix is a business that has historically, with the exception of a few quarters here and there, been free cash flow negative, and this is something that's always been a bit of a concern for me. And when we actually look to the statement of cash flows, we can start to understand why that is the case. So despite the fact that Netflix is profitable, at least from a net income perspective, and has been for some time now, actually from a free cash flow perspective, they're free cash flow negative. So when we scroll down to non-GAAP free cash flow here, we can see that for 4 out of the last 5 quarters, they've been free cash flow negative. And that's something that you need to understand as an investor as to what is causing that. And the reason for that is because they're having to pump a significant amount of money into producing that content, which is this line here. So additions to content assets, they're having to spend an awful lot of cash in order to produce content. And as a result of that, that's having a significant impact on their free cash flow. And the reason for that is because although they spend a significant amount of cash on producing this content, that actually doesn't hit the net income line until later down the line, when it's actually amortized over a specific period of time. Now, with that being said, management have said that they have now effectively laid the foundations enough so that they will be sustainably free cash flow positive for the remaining life of the business. Generally speaking, of course, that is, they may be the odd quarter here and there where they're not free cash flow positive, but over the long term and over the course of many, many quarters, on average, the company is going to be free cash flow positive. And as a result of that, an analyst from Fidelity Management have asked whether we have peaked in terms of the ratio of cash content spend to amortization, and how long it would take for earnings and free cash flow to kind of converge. Now, I don't think that they will converge completely, but we should see a much more stable sort of ratio between net income and free cash flow. Because at the moment, we're seeing net income of around $5 billion for a year, and then we're only seeing free cash flow somewhere around neutral. Over time, we're expecting that gap to be closed so that free cash flow will become much more similar to net income. With that being said, management were very wary of not putting a time frame on that actually happening, and I don't blame them for that. These things are difficult to predict. So we can see here that they said that it will continue to converge over time, but we don't want to put a specific prediction out there. I don't want to declare a specific peak. It's been going in the right direction over a multi-year period, and it will continue to do so. So then that brings me on to my valuation model for the business. So we can see here for years 1 and 2, I'm going with 13% and 15% revenue growth. And I've taken that directly from analysts' estimates. So we can see here for 2022, analysts are predicting for 12% growth. And in 2023, they're predicting for just under 14% growth. So actually my growth rates are slightly above that, but by and large, they are in line. We can actually see that their revenue growth has been declining over time, which is obviously a concern, but it's not all that surprising, right? Because I feel that sort of Netflix are reaching a saturated market at this point. They have just over 200 million subscribers or paying members. And as a result of that, you have to wonder how many more members they can acquire and retain, particularly with the increased competition that we were referring to earlier on. As a result of that, they have to increase their prices in order to maintain a reasonable revenue growth. And we see that in my model as well. Following that, my 3 to 5 year revenue growth is 12%, and my 6 to 10 year revenue growth is 10%. And as I said, a lot of that growth will actually be driven by increased prices rather than increased membership numbers. Now, in terms of the gross margin in my model, we can see that that was 31% in 2017, and that has increased up to 42% in 2021. I'm expecting that to continue to increase up to 45%, where I think that we'll actually plateau. Similarly, for operating expenses, that has gone from 24% as a percentage of revenue down to 21%. And I'm actually expecting for that to decrease ever so slightly down to 20%. But I think we've more or less hit a plateau on operating expenses as a percentage of revenue. Not to mention the fact that we actually earlier saw that the operating expenses as a percentage of revenue had increased quite significantly rather than decreased. So I think that I'm giving Netflix the benefit of the doubt here by saying that I think that this was just a one-off quarter. I've got a weighted average cost of capital of 10.3%, and then we've got the cash and cash equivalents here of $6 billion, and they've currently got total debt of $15.4 billion. That means that for revenue, we're expecting to go from $30 billion at the end of 2021 up to $87 billion at the end of 2031. And net income is going to go from $5 billion up to $17.2 billion. So a fair amount of growth, but it's certainly not the hyper growth that we've been used to seeing for this business. Now, in terms of what that actually looks like in terms of members and revenue per member, we can see that in 2021, they had just under 222 million members with average annual revenue per member of $140. I'm expecting that by 2026, we'll actually have just shy of 300 million members, and actually they will be paying $182 on average for the year. So a fairly significant increase. Now for 2031, I'm expecting the members to increase by around 4% per year to 362 million, an average annual revenue per member of around $241. So again, the sort of membership fees are going to increase at a greater rate than the member numbers themselves. Now, in terms of our discounted cash flow, we can see that they've been increasing their EBITDA margins quite significantly over the past 5 years, from 8% through to 22%, but we can see that that has started to plateau over the last couple of years. I'm expecting EBITDA margins to increase from 24% right the way up to 30% over the next sort of 5 or 6 years. Now, in terms of unlevered free cash flow, the point I was making earlier, that they've actually been negative for the vast majority of their life as a business, with the exception of 2020. With that being said, I'm expecting unlevered free cash flow as a percentage of EBITDA to increase from around 14% next year, and this is taken from analyst estimates for years 1 and 2, right the way up to around 60% by the time we hit sort of 2029. I do think that it's going to take some time for net income and free cash flows to converge, and I don't think that they will ever entirely converge just due to the nature of the business, but I do think that they can hit 60% of unlevered free cash flow as a percentage of EBITDA. Now, according to the discounted cash flow, that gives us a fair value of around $251 to pay for the company today. And if we go to the multiple of earnings, which is using a PE ratio of 10 years time based on their net income in 10 years of around $17 billion, that gives us a fair value today at $240. We take the average of the two and it's around $246. So that suggests to me that the business is still significantly overvalued even following the 20% fall in their share price, which personally is not all that surprising. Now, in terms of the rationale for the PE ratio of just 16, well, that's due to the slowing in growth, right? So effectively, by the time we get to 2031, this will be a business that has only grown, according to my inputs, at 10% per year over the last 5 years. So I find it difficult to effectively rationale any multiple that is greater than something like 16 for a business that's only growing at those kind of rates, and for a business that generates net income margins, which are pretty decent at around 20%. Despite the fact that the business is, according to my valuation, significantly overvalued, that doesn't necessarily mean that you won't see any return at all on your investment. So according to my enterprise value to EBITDA multiple, or my 2026 price target, we can see that I'm expecting 2026 EBITDA of around $15 billion. I apply an enterprise value to EBITDA multiple to that of 16, again, effectively with a similar rationale as what I just mentioned. And as a result of that, we get a 2026 price target of around $525, which would be a compounded annual growth rate of 5.5%, which for me personally, considering the level of risk that you're taking on by investing in a single company, simply does not make sense to try and get that kind of return. So for me, even at the current prices, even following the 20% fall in the business, Netflix is still not one that I would be interested in buying. And once again, it comes back to the point that I always make, right? Just because you enjoy the services of a particular company doesn't necessarily mean that that is a good investment. And valuation, as I always say, really does matter. Anyway, guys, I hope you've enjoyed the video, and until next time, thank you.